And I clicked the wrong thing. There we go. And we are live, Energy Week show, Energy Week podcast, Energy Week extravaganza. Ryan Ray alongside the good doctor herself, Dr. Ellen Wald. How are you doing, Miss
I'm
Wald?
doing great. We're getting some sort of tropical storm action here, I think. So please excuse if my power goes out in the middle of the broadcast.
Is that I meant to ask you? You mentioned that offline. I'm going to Mississippi this week. Is it going over that way, or is it going up the coast, or how's it going?
It's basically like over the panhandle and maybe some parts of it, but it should be gone by today, apparently. So I think it'll be fine later in the week.
Oh, I'm mute. There we go. Okay. Yeah. Okay. Well, good. So I head out tomorrow. I get down to Mississippi. I think on Wednesday, be there through the weekend. So, anyways, going to watch a little bit of bare knuckle fighting. So, your favorite sport,
Ooh.
obviously. Oh, speaking of sports, real quick before we get into the show, I tagged you in a clip this past week, and you didn't respond.
Oh,
With Daniel Jones, did you see that clip by any chance?
oh
Him throwing a.
God. Ugh.
I,
I'm
I know
sorry, but
it's coming on.
every time I see Daniel Jones, all I can think about is the description of him that someone said, which is, he's who you'd pick to play Eli Manning in a bad made-for-TV movie. And that just basically encompasses all of my feelings about Daniel Jones.
Okay, so I got a kick out of that, and you didn't respond. That's why I was like, I want to make sure you didn't miss it for everything else.
No.
Okay, we do have on Dr. Dean Foreman coming on here at 1:30, and so let's get into the normal schedule program. Okay, oil price drops amid faltering demand outlook in China. This was actually, if there wasn't other stuff going on in the world, this might actually get a little bit bigger news because it seemed like it was kind of getting a little momentum over the weekend or whenever it broke, and then it kind of got squashed for obviously more important stories. What do you make of this demand drop in China? Is it price related or is it economic related?
Yeah, I don't know. I think there's a lot of kind of haziness shrouding this because it seems like if you look at the quotes in this article, they're talking about concerns about the Delta variant in China and will this have impacts on oil demand? Remember, when they talk about the Delta variant, they mean China finds like 2 cases and then they like lock everybody in a city inside their apartments and no one can go anywhere. Not that like massive amounts of people are going to drop dead in the streets. So let's just remember that's
Right.
actually what we're talking about. But apparently there's like the third largest container ship port in the world has been like closed for 6 days because of some case of coronavirus. So, it's not like all that outlandish to think that there are, I mean, we're already seeing, that some serious effects of this, but also there were like, I think there were like things happening behind the scenes with Chinese oil refineries. I know that the government is kind of cracking down on some of these independent refineries. They were like trading quotas, and now they're cracking down on it, and that could also impact demand. So I think there's more going on. Like this article is saying like something is going on, but we're like not totally sure exactly what these issues are because it could be economic, it could be government related, it could be coronavirus related, and it just making everything look kind of weak and shaky. At least that's my take.
Yeah, and I mean, we've said it multiple times in this podcast, which is as the prices get higher, we whatever the mainstream media is telling you about the economy, there are people that are hurting, and so 60 to 65 or 65 to 75 oil doesn't seem high, but in China, they're listen, that's a lot of money coming out of a pandemic here, where you lost a lot of money if you're the average consumer, and you're being financed by the government. Same thing in the U.S., and so that's why you had your boy. Uncle Joe calling for OPEC to increase output, and so that's all. Remind me. I have a comment on that, by the way. But
Well,
so
I think we're going to talk about that next. So
yes. That's yes. But I have a comment that I need to say or forget. But um, China. The thing I think that's interesting is we talked about this kind of a few months back is can China put pressure on OPEC to get OPEC to kind of move according to what China needs, right? Because they are becoming a bigger consumer of oil. So if you look at China, if they're slowing down buying, can they put enough pressure on OPEC to increase production to get the price back down to incentivize to buy more? Because they overbuy when the prices are low.
yeah. It's a really good question, and I think did we talk about this last week, or maybe I may have mentioned it in a column I wrote last week, but that we do have some information that China has bought some additional cargoes of oil from the U.S. Because they were getting a better deal on it. So China's definitely not above diversifying its sources of oil. That being said, like look, Saudi Arabia and Russia are still going to be the main suppliers. US is not going to overtake them in any way.
Right. Speaking of OPEC, so this was the comment before I forget. I saw someone said that OPEC, had rejected Biden's request to increase, and someone says we're back to the 1970s now. Look at us, and I was like, seems like a bit of an overreaction. I don't know. What would you read?
Well, let's see.
I mean, U.S.
I
oil
haven't
production.
seen a whole lot of bell bottoms and
Okay.
or sideburns.
No, no.
So, yeah, but let's see. In other ways, um, well, Joe Biden is in political power, so that's like a constant.
Mhm.
Um, OPEC is running the show. I guess that's another constant. We have lots of inflation. We are messing up in the Middle East. There you go. That's another similarity. I'm thinking like Carter's failed mission to rescue the hostages from the Iranian embassy, and the U.S.
Right.
trying to evacuate people from the embassy in Afghanistan. There are definitely some similarities here.
But we could start drilling more oil in the U.S. and put more pressure on the market if we wanted to. Where in the 70s, we
Yes.
didn't have that capacity.
Not yet, but then we developed it in the 80s. I mean, we built
Right.
tap line and we drilled in Alaska. So, we did have and in the high prices in the 70s definitely led like American oil companies to make lots of money, and then they drilled more. So, it's not an unknown. I mean, I do think that there are definitely lots of differences between now and the 1970s.
But
But
but do you consider 60, what is it right now, 67 or something like that? Is that considered high oil prices?
Well, so that's the thing. I don't think 67 is necessarily high oil prices. 74, on the other hand,
That's getting there.
that's,
Hey, okay, now, after 2020, I think it's considered high, right? But if it was 2019, I don't think we'd be talking about that
fine. But
high prices, right?
in 2018, wasn't it almost at 80?
Probably for a little while. I had to look
Yeah,
at that, but
like
yeah.
we were close to 8. Remember when Trump was like, "Oh,
Mhm,
pump more,"
mhm,
and then they did.
mhm.
And now they're like, but we have to remember one of the so I did a bunch of media last week, and one of the things that I was kind of trying to emphasize about this whole thing is that yes, oil prices are the bulk of gasoline prices, but it's not the only component, and there are other factors that are influencing gasoline prices. So, for example, um, you've got inflation, first of all, which is impacting gasoline prices. You've got states that have increased their gasoline taxes that are making gasoline more expensive. California, for example, has this host of regulatory issues that it imposes on its refineries, which make its gasoline the most expensive in the country. It doesn't gasoline in California doesn't have to be more expensive than it is in Florida, but they've put things in place that make it that way. Plus, you've got issues with ethanol. So in June, we had reports that corn and sugar prices were at their highest, and going to be some of their highest this summer. Then there have been like droughts in the Midwest, which have also caused problems for the corn crop. So, ethanol is less than 10% of gasoline, but it's still a component of gasoline, and so that goes into the price. So yes, if oil prices come down, gasoline prices will come down, but it's not the only thing. Plus, it's the summer driving season. Demand is really high, refinery utilization has been high. Yeah, like I think that it's going to come down. I just see, like, as the summer driving season ends, I just think prices will come down, and this was like some sort of weird ploy to distract from really bad consumer price index numbers that were coming out in like like an hour later.
The other thing is it doesn't cost Biden any political capital, right? So with Trump, it cost him a bunch because there's plenty of oil and gas workers who are like, "What are you doing? We want the price at 75. We want the price at 80. We don't want it to go down to 40 and we get laid off." Biden the amount of the oil and gas industry that makes up his voter base is very small compared to Trump. And so for him to go over there, not to go over there, but to call over there and ask for this favor, it doesn't cost him anything. If they do it, great. If they don't, great. So it's kind of I thought it was kind of a shrewd move from his standpoint because there's no real, I mean, the left is not going to climb out for the climate change stuff because once you leave the U.S., the borders of climate change stop. So he's fine there. So I thought it was kind of a shrewd move on his part. Whereas Trump, I think, thought it was a shrewd move, but I know in Texas they did not go over very well.
Yeah, I mean, it was interesting, but also when Trump did it, the U.S. was producing over 12 million barrels a
Mhm.
day,
Mhm.
and now we're producing, at least according to numbers that we got to see on the API MSR, we're producing like 11.3, which is higher than the 11 that we were producing before, but you know, not. So there's a big difference there.
There is a big difference, but just from the messaging standpoint, which is how most of this stuff gets perceived. Okay, let's see here. China has thousands of hydropower projects. It doesn't want. It doesn't want them. Well, then why are they building them? Or is this a government? Is this a government joke right here? Can make the government joke or not?
Well, so apparently it seems like that they came about. So ever since Chairman Mao Zedong exhorted workers in the 1950s to quote conquer nature, because we all know nature can be conquered. China has been throwing up dams, large and small, at a prolific rate to generate power, tame flooding, and provide irrigation for fields and drinking water for cities, which are fantastic reasons to build dams. The long term effects of this often chaotic policy are now coming home to roost. I hate that. I wish people wouldn't use that in writing. Home to roost. Come on. Sorry. Apparently, a lot of these dams are too small to generate meaningful amounts of power. Some are redundant because the rivers ran dry and the reservoirs silted up, or they built other bigger dams upstream, so little dams don't matter. Oops. How about some planning? Um, so it's kind of interesting though because this comes at the same time as China is like recommissioning coal
Mhm,
fired power plants,
mhm.
excuse me. Um, Whereas like hydropower is a fantastic way to generate basically clean energy, but they want to get rid of them. I mean, it says there are a lot of like safety problems, especially because of summer floods. Apparently, one of the dams that it says these include the infamous Bangkyo Dam in Henan Province, which along with another 61 dams broke after 6 hours of torrential rain. Oh, this was in 1975, killing a lot of people. So apparently they didn't build the dams very well. Um,
But doesn't
but
this go to the point where like you hear the China mongering out there like China's gonna take over the world? It's like there are so many things they do poorly. So
yeah,
many things they do poorly. This is not if you watch Star Trek, this is not like the Borg with a well organized, like one collective movement. It's not what it is. Like
oh my god,
that's
I love that.
it's
Yeah, China, they are not the
they're
Borg.
not the
Okay,
Borg.
so if they're not the Borg, who are they? Are they like the Cardassians?
I would say, oh, this is
Are
gonna get
they,
me in trouble. I would say
they're not
they're
the
more.
Ferengi.
No, I would say they're most like the Klingons. So the Klingons always have this outward appearance of honor and tradition and loyalty,
Hmm.
and then inside the show they're always fighting and stabbing, and there's a lot of corruption and stuff like that. And that's kind of what I would say. Is China presents itself as very much
Okay.
a traditional and
Okay.
historical and stuff. But once you get inside, it's just full of corruption and chaos. So
Ooh, I like that. This is so interesting. Star Trek analogies.
technologies.
Um,
They're not the Borg.
yeah.
If they were the Borg, we should be concerned. The Borg are problems. But it's I think people we're always looking for an enemy to fight, and I don't have nothing against I have nothing against people in China, and that's not being derogatory towards them. I'm just their government planning is not as great as people make it out to be. It's just not. And when you look at stuff like this, there's plenty of holes in how the CCP has done stuff, and this is just one of them. And so, they're going to have to fix this hydropower stuff and make it where it's um, where either they tear down the dams or they're turning one into a tourism museum, right? So like that doesn't make much sense. It's like, okay, so is the river never coming back, or what's going on? So I think that a lot of this, when you look at China, and their quote planning, their ability to plan, they do pull off a lot of great stuff. And I said this before on this podcast. They will do stuff that will blow your mind, and then they'll do this. It's like, oh man, wow, okay, this is the train wreck.
What do you think about? I didn't read this entire thread, but I know Anas was talking about it last night about there apparently like there's a lot of like rare minerals in
Hmm.
Afghanistan, lithium and all sorts of other stuff. And what are your thoughts? Like, do you think China is basically like preparing to move in, make deals with the Taliban to mine this stuff, and get their hands on it? And is that? Do you think
Why
that's
wouldn't
like?
they? I mean, so there's I don't know if we have it in our rundown today, but China's looking to invest in the $17 billion Aramco pipeline. China doesn't care. They're just trying to make money, and they've got a workforce that needs jobs. They need infrastructure, and they need all this stuff. And so that's where their strategic advantage comes from. It's not this overarching, they're thinking for 6 millennia worth of planning, because as you just pointed out, Mao Zedong, who was alive in our parents' generation, like he's not, Mao is not from like, the time of Jesus. This is recent. And that stuff is falling apart. And so, yeah, it would surprise me if they go to Afghanistan and work out a deal with the Taliban. Why wouldn't they? They don't care about any of that stuff. And so that's the strategic advantage of the US, is they don't get caught up in all this stuff. They're going to do what they do inside their borders, and then they get outside their borders. They're going to try to strike deals that allow them to capitalize on opportunities. And of course, they're going to push the limits and try to control speech. It's not as clear cut as I'm making it sound, but what they're not going to do is try to invade your country. And so that's a big win. That's a big win.
Hmm.
We'll give you money and we won't invade.
Anyway, on
So.
that happy note.
I mean, so do you think they can? I don't. I saw someone yesterday saying that the Taliban will be blowing up China's pipelines in 5 years. I'm like, I don't think so. Why would they?
Yeah. I mean, do you think the Taliban are different now? Like they'll be like happy to just like hang around and like make money and make themselves rich and stop like, or are they the same kind of mercenaries that they were?
So you would know the history better than me, but I mean, what was the issue with the Russians? Was the Russians were trying to invade, right?
Yeah, well, so there was like this like quasi like communist state.
Hmm.
And so that's why the Soviet Union was involved because they were supposed to be like defending this state, this communist state, and it didn't work. And then the Americans were also selling weapons. They were funneling weapons like through the Saudis to the Taliban to defeat the communists.
Hmm.
Do you ever see um The Americans, the TV show?
Oh yeah, yeah, yeah. I saw a couple seasons.
Like at the end of the show, they deal a lot with like Afghanistan and the effect of
Hmm.
Afghanistan on
Hmm.
the collapse of the Soviet Union, and it was not an insignificant thing because like they spent a lot of money and resources there and could do nothing.
Right.
But I just like part of me went like, okay, are these the same guys as before? And some of them like are the same guys. Like they were in Guantanamo, they were but do they have the same? I mean, I don't know, maybe they've decided, like, is it gonna be like, you know, Taliban light? Like, are they just gonna wanna, like, sit around and, like, make money or, like, do deals with the Chinese and enrich themselves? Or are they really just I don't know, and I
They
don't
want to
think
make.
anybody actually knows.
They want to make money though, right? And they want to make money. They want to have power. There's
Yeah, but it seemed
look,
like they got off a lot on, like, harassing people.
China will let them do that too.
Obviously,
I
China
mean,
doesn't
China
care.
China won't care. That's what I'm saying. Like China seems to be a great partner for them, because China's gonna come in and say, "Hey, we'll do all this stuff for you guys, and you go do whatever." And listen, the Taliban will work with China because they'll say, "Hey, you can't criticize the Chinese government," and Taliban like, "Oh, great, you can't criticize any government," So like, I don't.
Yeah, I guess like last time they weren't like at least like it seemed like they weren't really they weren't so much like a real government so much as they were like a band of mercenaries who got money by collecting.
Right.
They basically collected tolls, like they controlled the access to the road, so they just extorted people for toll money, and they like sold drugs. Are
Right.
they going to be a little more sophisticated this time?
Right. So that would be the thing that China had to watch out for, is to get in there and, a separate faction over here isn't really working well, and so they're tapping their pipeline, or
Yeah.
they charging tolls, or whatever. That could be where they could get in trouble. But if they can centralize kind of command, then I don't really see a reason why China couldn't work with them or wouldn't want to work with them. So, but we will see. So in due time,
Yeah.
I say in due time. China's probably on the phone with them already. I did get this from right before we started the show. Someone sent me this headline from Yahoo News. Let's see, where is it? There we go. This is from Yahoo. Chinese state media mocked the U.S. withdrawal in Afghanistan, saying the Taliban took over was more smooth than the presidential transition in the U.S.
Oh boy. I
I love
expected
it.
that to come from Putin, honestly.
I love the Chinese propaganda. It's always something to get a hold of. Okay, all right. India will soon unveil a $1.35 trillion infrastructure plan.
I can't read
Uh,
this article anymore because apparently I've reached my article limit on Reuters,
Dude, Reuters, what's
unfortunately.
the, what's the deal? Like,
I
how
know.
we're free for like ever, and now,
I know. Now
ah,
it's just like you can't do anything. I was just curious because it seemed like it was interesting because I was like, oh, we just did a 1.2 billion or
mm,
trillion-dollar infrastructure plan or whatever in the world it is. Um, Here I'm gonna look up a different copy of this from U.S. News. Um,
well, I mean,
Yeah,
well,
how
here's
does their
this.
plan compare to ours? Do they have millions of dollars for the what was it? The Department of Climate demonstrations.
Yes, I think so. Probably twice that much. Well, this has to be the least surprising thing, though, right? After COVID last year, you're seeing these governments roll out big, huge, massive infrastructure spending plans to quote restart the economy. They have to give people jobs. Jobs were lost. Businesses were shut down. They're not coming back. And so one of the ways you make up that deficit is huge spending bills that create
Mm,
quote jobs. And so I think I talked about this with emerging markets last year, which is you're going to see this go down there at some point too.
yeah, Modi claims the plan will help local manufacturers compete globally and create new avenues for future economic growth. India's economic output fell by 7.3% in the
Yeah.
last
Everything.
fiscal year. That's interesting. Um, Also, the prime minister has set the target to become energy independent by 2047, saying the goal can be achieved through a mix of electric mobility, moving to a gas based economy, and making the country a hub for hydrogen production. Oh boy.
Mm,
He said the country spends more than 12 trillion rupees annually, that's rupees, not dollars, on
mm.
energy imports, and becoming energy independent is critical. Yes, I think that's definitely like a thing. But clearly before then, it seems like if they're going to do a big infrastructure plan, that that oil demand will increase in India. So
Okay.
that was my
Yeah, I mean, I just think you're
takeaway.
gonna see I think you're gonna see all these kind of infrastructure spending bills from all kinds of countries that they can get their hands on it. They have to generate economic growth, and if you've killed, medium and small businesses, whatever percentage, you look at our economy right now. I was talking to someone from my old hometown this weekend, and they told me this is kind of a funny thing, but they said that the Waffle House where they're at is not open 24/7 anymore because they can't find workers. And that's kind of a it's kind of a chuckle point, right? Like Waffle House can't stay open, but the fact that Waffle House can't stay open 24/7 goes to show you there's a fundamental flaw with the economy, and it's not because we're at 100% employment and we're paying people high wages. Like it's not that. And so when you look at these infrastructure bills, these spending bills, part of that is to cover up these deficits in the economy. And so whether it's here or in India.
Yeah, absolutely. So anyway,
All right. Let's go to
interesting.
Russia. You mentioned Putin. Let's go to Russia.
Yeah.
Rosneft to chase production growth. Okay, so how does this balance? Let's see here. The recent trends in the physical supply balances and energy prices underpin our drive to increase investment in production, according to Rosneft's vice president, some name I cannot pronounce.
He's
Um,
basically saying oil prices are up and demand's up, and we're gonna, invest more in E&P and supply more energy. It's as, I think that's like, I think it's interesting because we're looking at other oil. You're looking at oil companies from the U.S. You're looking at Exxon. You're looking at Chevron. You're looking at BP and RDS, and like none of them are looking at expanding production at all. If anything, they're trying to sell assets. And instead, you've got Saudi Aramco last week when it announced its Q2 results, saying we're investing in expanding our oil production to 13 million barrels a day. I'm not their capacity, not their actual production. And I have Rosneft saying, hey, we're looking to increase our crude oil production. Well, what does this mean for the future? It just seems to me like like a self-fulfilling prophecy from like the Biden. I don't know, like here we have Rosneft is like, oh yeah, we're going to expand production too. Here are the fields we're expanding in, and the only people who are expanding are like Iraq, UAE, Saudi Arabia, and Russia.
So how does this go with what the OPEC announcement we covered earlier? OPEC's like, we don't need to increase in production. Is this more of a long play from Rosneft?
Yeah. This is the longer play.
Yeah.
Yeah.
So
They're not talking about like, oh, we see our future in hydrogen production.
right. Yeah, they drill, baby, drill.
Yeah.
Well, the Russians. I mean, I think if you're Putin, who's gonna criticize you? Speaking of criticizing, whatever happened to not Novak, that Russian dissident that they put in jail? Is he still around?
He's still in jail. Yeah. He's
Oh,
still in jail.
yeah. Oh man, that's gonna be brutal. Like I've seen one of those shows with the Russian prisons, and they are just absolutely rough. So I want to pass on that. But anyways, I don't know. Any final thoughts on the Russians in production?
Yeah, I'm wondering if like, before we were like, oh, is the US, ceding power to OPEC? I'm wondering if like that's gone. Like they've already done it, because just the fact that these are the companies that are expanding production and the US is talking about it, like eh, is it gone? Like they've already lost. Have they already lost?
Yeah.
Or is there more? Is there this like magic shale something that can come out there from like it's gonna like jump out of nowhere and take everyone by storm again? Like, is there shale? What is it like 4.0?
4.0, a new iteration. Well, okay. This morning we talked about the Ramco pipeline. It's got $17 billion in funding, and JP Morgan Chase and Goldman Sachs are the two bankers that are kind of shopping this around for Ramco. And it's like, really? I thought we were not investing in the U.S. I thought we weren't investing in the banks weren't investing in oil and gas anymore. And here you're shopping around a $17 billion pipeline for Aramco to China, to Dubai, to all these other countries. It's like,
Yeah.
oh gracious. So I don't know. Maybe things will turn back around. Okay, now we have joining us for his here monthly
Yay.
visit, Doctor Doctor
Oh,
Dean.
there you go.
Let's see. I can't do what I'm struggle busting. There we go. Okay, Dr. Foreman, good to have you on. How are you doing, sir?
Great to be here. Doing really well. How are you?
I'm good. Ellen, how are you?
Yeah, things are good. We're hanging in there. Wild day, but
Wild week.
that's true.
It's only Monday. It's a wild week. Okay. All right. So let's get into the monthly statistical report, which will be out this Thursday on the 19th. So this is not yet released. According to the API's primary data for July 2021, summer driving and gasoline demand led to the highest U.S. petroleum demand since November of 2019. So we're getting back to the pre-COVID era with one of these indicators, and that's a good sign. It sounds like.
Absolutely. Yeah. Demand's come back. It's come back along with the economy. It's pretty obvious when we look through the details of this month's data that gasoline and jet fuel were the uplifting parts of it. So it is summer travel, and it's to some extent probably pent up demand for that travel. But it is a sign that the desire for personal travel is definitely alive and well.
And so if we let me rephrase it like this then, because I agree it's a good sign, but someone might say, well, listen, comparing the summer driving to demand in November seems like we're still kind of off the mark. So how much off the mark are we?
Well, not that much, actually. If we're comparing back to the same period in 2019, we're still basically within a couple of percent. I'd have to go back to the exact percentage. And it's varied from week to week. So if we're looking at gasoline, it was within 0.8% of where it was in July 2019. So it's basically there. And, we've had weeks since then on the weekly data, and keep in mind our monthly statistical report, it's the most timely monthly estimates that are out there, but they only go through July right now. And some of the August data points have been well over 21 million barrels per day. So we have seen this continue to be strong, despite the fact that oil markets seem to be discounting right now as we're just looking out the window, maybe a little bit of softness or softening in the growth of this demand.
Yeah, and you couple that, you have the lowest crude oil inventories since December of 2019. We've seen a lot of
Absolutely.
draws, we've seen some builds, but that's a good sign for the prices at least.
Well, the market's definitely reacted to that. And I think the context is really important here because we've seen these inventories get drawn down from some historically high levels by almost 16% year on year as of July. And now they're sitting only a little under 7% above the very lowest point of the last 5 years. So it's not a troubling extent, but it is definitely showing that the movement within 1 year can swamp what we're seeing, as far as the amount of headroom that there is above the lowest for the last 5 years.
And I know that we've seen some record refinery utilization. I think it's been at 91%, you mentioned. But how much of the inventory drawdown is impacted by exports, by U.S. exports?
This is an interesting period because we've gone through where we had healthy growth in exports for a while. And then for the last, for like 4 of the last 5 months, we've been a net importer again. And the exports have actually been under a fair amount of pressure. So the refining activity that you mentioned, sustaining 2 months now over 91%, that's not a record, but it is strong. I mean, that's a pretty healthy throughput at that point. And only in 2019, which was an astounding year, did we average much higher than that. So the fact that we've gone back for a couple of months to that, it is a combination of supplying both domestic demand and replenishing inventories, but also having some exports. And we're still a net exporter of refined products. It's that we're a net exporter of more crude oil net importer of more crude oil. And that's what's been resulting in the crude oil the petroleum net import balance so far.
Okay. Yeah. So one of the questions I had was looking at the economic indicator, and so if you kind of look at it, we're blown past everything else that you have on this chart. And I was talking before, it doesn't feel like we're back to a full recovery. Help me understand what's going on with this economic indicator.
So the way API's economic indicator, and this is a distillate economic indicator that correlates very strongly with the year-on-year change in industrial production for the U.S. And keep in mind, we're sitting here in August, even 4 months removed from a year ago, the lowest point of this downturn. The year-on-year changes are still a bit volatile, if you will. Okay. So we've seen this indicator suggest that you'd have a really strong year-on-year recovery. That's continued. There is no question when we look at other indicators of industrial production, like the Institute of Supply Management's Purchasing Managers Index, that one would still show like 17 of 18 of the different industries surveyed are growing. Now, the extent of growth and what we're seeing in the monthly data, as opposed to an average over 3 months for the distillate economic indicator from API, is that it slowed a little bit this last month, but it's still slowing from some historically strong levels. Last month's reading on it was the highest we'd ever seen. So this is saying that the industrial side of the economy is continuing to remain strong, almost overheating, and pointing towards some inflationary pressures. Yeah. And we see this also in the University of Michigan's Consumer Sentiment Survey. So, and they didn't mince words when they quoted it. They see the top complaint coming from households being the affordability, with prices going up for houses, for vehicles, for energy, for food, healthcare too. And on top of that, pointed toward, they thought in a forward-looking sense, that consumers were most concerned about price inflation, that there could be a reckoning in the not so distant future, in their words.
Tell us about petrochemicals and how we're doing on that respect, because it's been a very strong area for the U.S. even when others weren't. And how is that looking?
It's a great question. It really has been the strongest area of sustained growth for U.S. oil going into products in particular. And whether it's variants of COVID that have come or just a continuing need for medical plastics, in particular propylene packaging, a shift towards online retailing, that's been sustained here. This last month, on a month-over-month basis, we saw a little bit of slippage in that sector, but it's still the highest ever for the month of July. So it's a record there. And since we're talking 5.6 million barrels per day, this is still more than a quarter of U.S. petroleum demand. So it really is an important sector and an important sector for growth going forward.
What do we make of, let's see here, I'll get the exact quote right. NGL production being the highest for July.
Well, one of the things that's continued to grow, and the natural gas side, our survey data we address natural gas liquids, but not natural gas. But we fill in some of the gaps, if you will, by looking at EIA's coverage in its natural gas weekly update. And, we've seen really strong, and in some cases, from month to month here, record levels of U.S. liquefied natural gas exports. To export LNG, you have to take the natural gas liquids out of the gas stream. So you fractionate the gas, you remove these, and then you have more field production of natural gas liquids. And this is showing up. So despite the fact that natural gas overall production, marketed production has not been increasing markedly, it's been kind of flat along with the drilling activity, we've seen NGL production continue to grow toward 5.4, 5.5 million barrels per day. So that's quite substantial. And keep in mind that the whole of crude oil production for the U.S. this last month was 11.4 million barrels per day. So, almost half of this, again, in NGLs. That's pretty astounding.
Could you maybe talk a little bit about crude oil, the crude oil production increases that we are seeing in the U.S.? And because I know that on previous episodes, you've mentioned that you didn't see production increasing at the same rate as the IEA surveys predicted. How does what we're seeing now compare with that?
Well, that observation still holds, and it was really EIA's supplied, the U.S. Energy Information Administration.
Sorry.
They're supplied. No. And IEA has been a little bit more bearish on the U.S., and I think the International Energy Agency has actually gotten it a little bit more right for the U.S. this year. But look, these are historically based relationships that would show if you go with crude oil, at high 60s, low 70s, that you should see a pretty healthy drilling response. And it's only in this last month in the MSR we observed from Baker Hughes data that we're seeing continued creeping up of oil-directed rigs, so rigs that are targeting to drill for oil as opposed to natural gas or both. And it's a little bit, it's not a lot, I want to be clear. So we have been, so far this year, kind of range bound. We've gone up and down within a range of about 10.5 to 11 million barrels per day. And only in the last 2 months have we seen it kind of break out slightly above that. So we went up to 11.2, and here we are at 11.4 million barrels per day for July. That's a good sign that it's continuing to creep up along with additional drilling activity. And that drilling activity serves as a leading indicator of where the production could go. So that's a good sign if you're looking at Baker Hughes data for where crude oil production might go from a U.S. standpoint. It's going to take a while, but it is going that direction. The natural gas side's been a bit perplexing because natural gas prices have recently been above $4 per million BTU. And keep in mind that they were under $2 per million BTU a year ago. And on top of that, the 6-month futures, so going from today, futures prices out 6 months, have also been above $4 per million BTU. Based on any estimates from BTU Analytics, Rystad, any of these sources that you would look at, you should be able to drill gas all day and make money at $4 per million BTU, just dedicated dry gas, not even associated gas coming from oil plays. So this is a bit of a conundrum because you're like, okay, why don't I see more natural gas drilling activity picking up, even if I'm starting to see a little bit on the oil side? And this goes back to some of the things we've talked about in the last couple of months, that many companies are still either capital constrained or people constrained, having gone through all the structural changes that they have over the last year or two. Beyond that, if you're expecting associated gas along with crude oil production to come back and you're sitting up in Ohio and Pennsylvania, you might not drill because you're expecting the associated gas to come back. And the third part is that it really is separating the wheat from the chaff in the sense that we're seeing like a Gulf Coast producer that might be tied in some way with LNG exports. They would have a reason to drill because this demand for LNG exports is continuing to grow. And those exports would beget their own supply, their own projects, their own drilling that would be dedicated to that by and large, not entirely. But if you're sitting up in Appalachia, Ohio, West Virginia, Pennsylvania, you're not locationally positioned where you're likely, the first place your gas is going is the domestic market as opposed to a foreign market. You might be backing out some Canadian imports as you push some of this gas west up towards Canada or down toward the Gulf Coast. It's competitive, it's very economic, but the key dynamic that might be shaping that is the power sector. And with $4 gas or above, there's a lot of gas that's being taken out of the power sector and being replaced by both coal and renewables in the power sector. And this is what EIA expected in an accurate sense to happen this year, and in fact has happened, where particularly in the Midwest, in the Southwest, where we have a lot of coal availability, very economic, we've seen 20 to 30% declines in those regions of natural gas going into power, and then coal and renewables taking up the slack. So if you're in Appalachia and you want to drill, it's great, but you have to have a market for it. And then even with this, there's an infrastructure constraint issue. If you want to grow substantially in the long run, you probably need a bit more pipeline egress to be able to ship that gas. So in a nutshell, those are the factors that are shaping gas markets to go along with oil markets.
It's hard to imagine if I would have told you that WTI be sitting at 67 and natural gas at 392, that you wouldn't be saying that every rig in the universe would be in the Permian Basin right now because of the blend that they get out there. And so it's really an interesting dynamic as we talk about, we talk about the oil price so much, but when you look at the natural gas price and how much more profitable those shale wells are in the Permian when natural gas prices are up, it's really something to behold right now.
That's absolutely right. And no one will feel sorry for the industry if they don't take this opportunity to move forward. But at the same time, you've got a few things. I mentioned capital limitations. Think of how much debt many of these producers took on just to survive last year. They have to right the ship and figure out how to have the balance sheet right before they invest to grow. That's one. Coming into this year, they set a budget. They set that budget based on an activity level that suited the people, the workforce that they have. If they want to expand beyond that, they have to not just hire, but commit to hire. So if you're going to hire a rig, it's going to be for a year or two when you sign the contract. It's not for a month. And on top of that, you just have to have a risk tolerance choice of, will investors reward you for growing at this point? And I think the risk tolerance has also changed in the industry a bit as a result of everything that we've gone through.
Yeah. Okay. All right. Dr. Wald, any more questions from you?
I have other questions, but I don't think they're so related to this report. So I'm gonna hold off on. Well, I was just curious about how you think that the ongoing moratorium on oil and gas leases is maybe impacting some of the lack of growth in natural gas and oil drilling.
Thank you for asking that, actually. And I don't know if you've seen out on API's website, I put out an article today, and it touches on the fact that the administration last week made this appeal to OPEC to increase its crude oil production at the same time as the Biden administration is putting a lot of pressure on domestic producers from a policy standpoint, both through this moratoria on new resources, revoking pipelines, it's signaling that they really want an enduring shift off of fossil fuels. And it's hard. This is the other thing, right? It's a longer term thing as opposed to a shorter term thing. But when you signal that you don't want this industry to have a future, it's really hard to get people to invest vigorously in that future. And the Biden administration is clearly signaling that they see a need for consumers to have liquid fuels in the interim. The question is whether they have a plan for consumers to be able to afford it. And based on that, it appears not. The other thing they did last Wednesday was they appealed to the Federal Trade Commission to investigate summer gasoline prices. And they marked, or they noted in a letter, that they saw a divergence between retail gasoline prices at the pump and crude oil prices. And it was specific to the 2021 driving season. Well, there's only one set of data for the 2021 driving season. So you look at EIA's data, both on retail prices and on what refiners have paid for their crude oil. And you find that the ratio of those two is actually at the lowest point that it's been in 3 years. So it's like, it's nonsensical because it's actually a lower markup, if you will, than it has been. No reason for an investigation there.
Okay. Ellen, go ahead.
Oh, actually, that's so interesting because this was such a hot topic, at least in the last week. And I think a lot of people don't quite understand what goes into pricing gasoline, and that's a very interesting fact that actually it's better than it has been. Perhaps they need to look outside, for other factors that go into gasoline prices other than oil.
Well, it presumes that they actually saw a divergence between the retail prices and the crude oil prices that hasn't existed, at least we really only have June data for this driving season. So it becomes a mystery of what exactly they're pointing to, and if it's anything other than a diversion to try to politically get attention onto, it's interesting. In this industry, you go from these challenging times and hard to invest to suddenly the prices go up and you're accused of being a profiteering glutton. I mean, it's one extreme or the other here. And when we look at it, if you were looking at the non-crude oil part of it, EIA's own data would say that the portion of the retail price that's represented by crude oil has continued to go up. In fact, it jumped a lot in their June estimate, from 52% in May up to 55% of the retail price of conventional gasoline, according to their estimates. Now, the other parts of that, you've got refining, distribution, marketing, some reasonable rate of return in EIA's methodology and the way they factor that in. And some of that, when prices had gone lower, was going up. And one of the components that goes there, you've got state taxes that have continued to go up in many states. You also have the cost of blending ethanol, whether it's through a RIN or actually buying the ethanol, and those prices have gone up a lot with supply chain issues of this last year. So there are a lot of other components that you could look at. It would have been interesting if they hadn't narrowed their inquiry and said, this is about the summer driving season, because I think you probably would have reasonably found some variation in things, both with the dislocation over the last year that the markets have gone through, the extreme winter storms that we saw there in Texas for you and Oklahoma back in February, the Colonial Pipeline outage in May. I mean, we've had a lot of interesting market events where you might expect that you'd see some local variation in these kinds of things, but that's not where they went. And at least in terms of what we see in the official data, there's really nothing there. And in fact, it really is easy to see through in that regard.
Okay, Dr. Foreman, anything that we did not get to before we get you out of here today that you wanted to make note of before this report comes out on Thursday?
No, I think the key takeaway here is that as demand has continued to outpace the recovery in supply, we're a net importer again, and that has a real cost. So energy policies that continue to reinforce domestic supply, that is the most assured way of answering all of these issues we've just been talking about, of helping keep downward pressure on prices. And if we're just comparing year on year, we've gone from a period where we at one point had upwards of $10 differences between domestic and international crude oil prices, and lately they've been just transportation-based cost differences of $1 and $2 per barrel. So in that range, the U.S. energy revolution, a lot of things that have really advantaged U.S. consumers enjoying relatively less expensive fuels than the rest of the world, that's been under a lot of pressure here. So if people are interested in more detail, I'd encourage them to please look at API's website, the articles, these reports, and the chief economist section at api.org. It's in the upper right hand, and we've got all these reports available.
Okay, Dr. Foreman, look forward to getting you on again next month. And, we've talked about the end of driving season on this podcast. What will that look like as demand kind of goes back down some, and how will that impact prices? So a lot to discuss in the coming months.
Sounds great. Look forward to it.
Thank you for coming.
Great seeing you.
Okay, once again, that is Dr. Dean Foreman with the API. Be sure to check it out at API.org. And as he said, chief economist at the top right. This will come out on Thursday, but Ellen and I are super cool, so we get the VIP status.
Mhm. It's
Dr.
like the first super cool VIP status for anything I've ever gotten in my life.
I've never been called super or cool, so there we go. Okay, Dr. Wald, any final thoughts before we get out of here today?
Yeah, I think it's interesting to note that API, along with some other organizations, are apparently now suing the Biden administration over the moratorium on leasing. So that will be something to keep an eye on.
Okay. All right. And with that being said, where will you be this week?
Let's see. So I will definitely be on investing.com this week. That's all that's in the books for now. Although I will definitely alert our listeners to other upcoming appearances.
Okay, I will be on Inside the War Room. Ryan Gradowski, Republican strategist, commentator, writer, is coming on tomorrow, and he explains why he wants to catapult me to Mexico. So if you want to hear that, that's on Inside the War Room. And also, James Rosen, formerly of Fox News, will be on the podcast this week as well. So,
How are you getting all of the James Rosen? Wow. Wow. This is
for
a
our
cannot miss podcast. Like,
yeah, well, we're trying. And for their Tiger King fans, which Dr. Wald is not one of, Carol Baskins is coming on the program at the end of this month. So I'm pretty stoked about that. So, anyways, so be sure to check out Dr. Energy at Energize Economy and myself at Ryan Ray Sr. on Twitter. And we will talk to you next week.